Good afternoon, everyone. Welcome to our live trading session for six-figure portfolio coaching with Michael Schulman. It's the noon hour here on May 20th, and we're going to do our live trades now. This session will be recorded and will be posted on the website in a couple of hours. Michael, let's take it away.
Sure. We'll get started. We'll keep this brief. I gave you sort of a preview, a précis, if you want to call it, of the three different positions we will look at today. But in addition to you already having some advanced knowledge of what I'm going to be discussing and showing, and not forgetting that this is a program for both coaching and for making a profit, we're in our fourth session, fourth week, plus the boot camp. Today's trades all look quite good, depending upon, at this point in time, last time I looked was about 11:45, depending upon your preferences. I will indicate what may be best for depending upon your preferences as we go through. At the same time, this is also what I would call coaching or a new experience concerning a multiple position trade or multiple position transaction on specific names. So what I want to do immediately is go to the chart for the first stock, which is Seadrill, and then we're going to go to the calculator after we look at the chart. And I want to know if we don't see the chart, we should be. That's actually Verizon, but let me go to Seadrill. And here we have a pretty decent movement in the shares, and it clearly has settled in. It's been at 35. This is a 6-month chart. You can see for almost 4 months it's been hanging around, and that goes through one earnings announcement where there was a little dip, and the ex-dividend date there's a little dip. You can see how it really is hanging in quite nicely at the $35 price point. I'm going to show volume support here, and you can see between 34 and 30.
Michael, you need to. We can't see the chart. You need to click on the green button. Remember?
Oh, okay. Sorry about that. I thought I had it. How's that?
There we go.
Okay, thank you very much. And you can see that within a 3-month period, there was a lot of arguing about the stock right at its current price, about $35.75. Let's take a look at the previous month. You can see that a base is building over here, short term. This is a 30-day chart, and it's still pulling away a little bit. And you can see on the 10-day that you have a lot of action here, trying to break through. The reason I emphasize the short term on Seadrill, and now we're going to go over to the calculator that I showed you last night, which will be posted with our final decisions and results after this is all over. But it's a real live calculator. In case you own the shares, you can put things in. And if Dave, is the calculator coming up?
It's coming up.
Okay, good. So these are the current premiums and so forth and so on. Now let me walk you through this and what the goal and intent of the trade is, and give you, pardon the pun, some options of how you would do this. Here we have the stock price, and here we have the premiums, which I know really that these are the latest. We're about 11:30 or 11:45. They're not going to be more than a nickel off. Here is the premium that I'm assuming Seadrill has said it's committed to maintaining or increasing its premium throughout this calendar year. The 98 cents was the premium in the last quarter, the dividend yield, excuse me. So now you start looking at the rates of return of what happens if you sold a 35.50 put, which is in the money, because we're up here at 35.79. You're in the money at 35.50 for June, but take a look at the premium. Oh, that's the total cash, excuse me, sorry. Let's go back here. If you sell at 35.50, you're going to get, and it's probably right around 25 cents. It was a big spread on this. So here, let me step on step one. You're looking at the premiums if you sell this week's put. That would be step one. If you either wanted a short-term trade where you're just selling a put and you truly are willing to roll it, or you're truly willing to own the shares, or if you're following a covered combo formula, you're hoping to be put the shares and collect that extra premium by selling them an in-the-money put, which these both are, and being put the shares. And of course, if you're not put the shares, if the stock runs, look at these annualized rates of return. I mean, think about it. These are the annualized rates of return. If for some reason the stock closes above 36 at the end of the week and you're not put the shares, these are very, very, very high aggressive annualized rates of return. So there's no downside, even if you're trying to be put the shares, there's no downside based on rates of return if you are not put the shares, because we don't have the ex-dividend date until June 5th, and therefore you have another week to either do this again or simply flat out buy the shares if you want to collect the premium. Step two in this trade, you would accept the shares, assuming that you're in the money, And then step 3 here is you're going to sell a call. So if you did this trade today, you would automatically turn around and sell a call. You would do it as soon as the trade is, excuse me, I apologize. As soon as you put the shares, you would sell the call, which would be next Monday. Well, next Monday is Memorial Day. It would be next Tuesday. So these prices will probably be a little bit different, but I wanted to put them in as placeholders to give you a sense of the annualized rate of return. But this calculator, which we're leaving on the website when we're done, you can input your own prices and do the annual rates of return yourself. Here's the dividend yield, and here's the accumulated cash if you include the premium from the put, the premium from the call, and the dividend. 3 different chunks of cash in your pocket with an expiration for the 3rd week in June. So roughly within a month, you'll have 3 deposits of cash, and these are the annualized rates of return. Now, we know that we're getting these exceptionally high annualized rates of return, not just because of anticipation of the dividend, but, and here's the warning, Seadrill has an earnings announcement on May 28th, and it can be very volatile around earnings. We discussed that last night. And that's hopefully part of the decision process that you're starting to make. Do I want to expose myself to earnings? And one of the things here's the, if you don't get the dividend, you still have excellent rates of return on 3 of these 4 positions. This position, which only has a 22% annualized return, is because you're selling a significantly out of the money call and you're not collecting the dividend. And you're making more money here from selling a deeper in the money put. And so that's the reason you have a 22% return rather than something higher. I added from last night, I added an alternative view if you're called out before the ex-dividend date. And that means, of course, that the stock is run. And you'd have to make a decision in the real world if that really happened, what you would do. But the bottom line here is you can see these are very, very, very good rates of return. I'm gonna walk through these with these numbers. Well, actually, let's go back to Seadrill. I'm going to click on this green button here and call up the chart, and someone's going to tell me if the chart doesn't appear. Okay, you can see the stock now is moving up fairly strongly, and pardon the double adverb, and you're looking at option chains that are beginning to move away from you. Although we still can get 20 to 25 cents, we can still get the 45 cents. So now we've double-checked this position. We've double-checked this trade. The premiums I have in the calculator are still pretty much on target, and we're pretty cool with them. And you're actually even a little safer here from the 35.50 put as a straight trade because the stock is beginning to aggressively move up. My guess is the calls are going to be a little bit richer. That's the calls, and the calls are a little bit richer. They've gone to $1.20 and 65. And so you can see this trade is already moving in the favor of the direction that we anticipate it coming. So I'm going to recommend just flat out right now, we're going to go back here. If you want a very short-term position, I'm highlighting this right now. If you're only a weekly trader and this is just a weekly put, you're not doing covered combo, this is the weekly position. Okay, this is the one that you want and that you want to do, you know, as soon as you can. That's the weekly position. If I go through all this, remember you're exposed to earnings. And so because you're exposed to earnings, you're really making a mental a decision, earnings are going to be good. They may not be. But you have to have the confidence that earnings are going to be good. Well, if earnings are going to be good, then you're going to sell a deeper in the money put. You're going to sell the 36, and you're going to sell the 37. You're going to sell the 36 and the 37. This would be your covered combo trade. But this is the covered combo trade, and assumes earnings beat. And when I mean beat, I mean it matches the expectations of Wall Street. It doesn't have to necessarily be a clean beat. These are the two ones.
Michael, we're not seeing that. We're seeing, we need to see what the short-term trade is, and we're just seeing the chart.
Are you seeing the spreadsheet?
No, the chart.
Oh, I'm sorry.
If you could just also talk about
I'm not normally this clumsy. I apologize. There we go. Let me see if you're seeing it.
Yes, we are.
Okay, my apologies. So here highlighted in yellow is the weekly position. Here highlighted in yellow would be the covered combo trade.
Yeah, slow down. If you can go through and actually give the trades out.
Well, what I'm looking at is if you want something just very short term, as if this was a straightforward, if aggressive, options income blueprint trade, this is the trade you want. You want to sell the May week 4 35.50, which is already down actually. Last time I saw it was 20 cents. You're still getting an extreme rate of return. That's the short-term trade if you don't want to do anything with the stock longer term. If you want to do something longer term with the stock, this is the position I'm recommending. All of these are good. You can, and as I said, I'm giving you choices here. This is not firm, hard and fast recommendations that this is the only thing you should do. You have a lot of latitude, and this calculator, of course, will help you make some decisions if you plug in prices or if you already own the shares. And so this is the covered combo trade. Correct the typo there. And that's the one that I would recommend if you're going to continue with the stock. If you're going to hope to put the shares and you're going to turn around and sell a call. But just remember, we have earnings on May 28th. There's always the possibilities that earnings missed and the stock would sell off a bit. And you'd be put the shares, and on paper, you'd be down. But as you saw from the chart that I showed, it rebounded very quickly off of a little bit of a disappointment with previous earnings, in part because it's an 11.8% yield, and the company reiterated its forecast for the year of maintaining its dividend.
Could you again describe the covered combo trade in detail for everybody?
The combo trade, I'm sorry, I'm just assuming we have a memory from last night, and I apologize.
No, not what it is, what the actual recommendation is.
Oh, the recommendation here is to sell a May 36 in the money put, a May week 4. Okay, a May week 4 $36 put. That means you're about 25 cents in the money. You're going to collect, and in fact it's up here, you're going to collect 45 cents in premium. That's the spread is very large. Use limit orders. It's 35 to 55 cents. Shoot for 45. You're going to collect that money, and when you put the shares, if you put the shares, you're going to turn around and you're going to sell the June $37 call, and you're going to collect this kind of a premium. Now you may want to sell the $36 call, which technically has a higher return. But there's always the possibility that you would be called out. And if you're called out, you have a very, very nice win down here at 68%. So and remember, you're going to be moving in and out of the stock if you're in the covered combo mentality. So I like the May 36 and the June 37 to help you collect the premium and so forth and so on. Those are the two positions. So to recap, short term, you're going to just sell the May week 4 35.50 put. For the covered combo trade, you're going to sell the May week 4 $36 put, and if you put the shares, hopefully you are, next Tuesday, or over the weekend, on Tuesday you're going to sell the June 37 call. And you have to be very mindful before you make this trade. You have to make a decision about whether you want to be exposed to earnings. So that's what we're going to do there. Now we're going to go on to something sort of in the polar opposite. I'm going to go back to charts here in terms of stability and volatility, and that's Verizon. Let me call up the screen. Here we go. Dave, keep me on track. Make sure the screen's appearing. Do we have an option? Do we have a screen? We have a screen. We have a brokerage screen. Okay. So Verizon's selling off a little bit today, which is actually good for us. Let's take a look at the chart for a second. You could see where it's recovered a great deal. And it went down here, just a simple sell-off in the telecom sector and fear of price competition from T-Mobile and here's the 3-month chart, and from AT&T. Now let's look at the short-term chart, which is 10 days. It sort of gap opened on the AT&T news because the AT&T DirecTV merger puts a price on the value of a wireless company and a landline company such as AT&T. And now the traders are retreating and the investors are coming back in, and the investors are going to take a stand probably about $48.50. This, as you remember, we did a very successful sale of a Verizon in the money put, and it went above the price, and I think it's going to do it again. So we're going to go and look at the options change because I think obviously some things have changed. So let's take a look at the June 49s. They're now 76 cents. And let's look at the June 50s, which are now $1.37, and we're going to go back to the calculator and plug these in. So let's go to the calculator, and Dave, scream at me if it's not coming up.
You're good.
Okay, so we're at $48.91, and the June $49 are now 76 cents, and the June 50s are now $1.37. So you already have here, if you like the stock, And the stock was 55 bucks a year ago, and I own the stock. I love it. And it's a very clean, straightforward, once a quarter to 6 times a year double dividend trade, with far less volatility than Seadrill. It doesn't really move as much on earnings. It sounds like you're sacrificing premium and perhaps profit for that stability, and you are. And there's a real value to that depending upon your trading preferences. So for here, we're setting up a real covered combo trade. I'm not recommending you get into a monthly position. It's the kind of thing I might do in Options Income Blueprint, although we rarely sell it in the money put. You would sell a June 49. The stock is below 49. And after you sell it, you would turn around if you put the shares next week, and you would sell a July 49 or a July 50 call. Now, these prices have probably come down, and I'm doing a little guesswork here, but I'm guessing that's what it would be because of what happened with the puts. So if this was a straightforward trade, that's the return. Now let's put it all together, because step 2 is you accept the shares. Step 3, you would sell one of these calls. Step 4, you're collecting it's at least a 53-cent per share dividend. They practically never go backwards, and 53 cents was the dividend from the last quarter. And now you put your cash together. So you can see the returns are lower, but they're also quite high. And Verizon is a stock you can do this 4 times. This is a 4-time-a-year thing, but if you do this 6 times a year, you're not even including the amount of money that you would make as the stock appreciates. And you can see down here, if you don't get called out, and if you do get called out, excuse me, and you don't collect the dividend, you still have very acceptable returns. This goes back to my opening comment about preferences. Some of you may not want to deal with Seadrill's earnings. Some of you may not want to deal with a more volatile stock. One of the reasons these returns are lower, by the way, and I need to put this caveat in, these are July's. So in my calculation in all these numbers was I assumed we waited until the call expired at the end of the 3rd week of July. If you bought it back early because it was profitable to do so, then these returns on an annualized basis would go up significantly because of the way we do this. Let me show you. You're multiplying by 6 when you do this calculation, and we do tracking and performance in the last session. I'll give you some handy-dandy tips on how to do this realistically. I do this conservatively. So we're assuming it's a 2-month position, and of course, if it's a 2-month position, you multiply the results by 6. 6 times 2 is 12, the number of months in a year. In reality, this could be a 1-month position. It just depends upon how you're managing it. But so I've taken a very conservative approach to these numbers. It'll be the same when we go to Blackstone. Is there a trade here? Yes. I think the trade here, to me, is very obvious. And excuse me. And that's this position right here. I think Verizon is immediately coming back. Is immediately coming back and going to cross $49 again. Within the next few days, as we saw it cross the $48 threshold. I suggest you sell the 50 because of options expiration. Ex-dividend date is before options expiration. There'll be a ceiling at 50. It's a very emotional and as well as a technical point, and you can always roll them forward if you want to collect the premium. But I'm not picking this just because of the number. I just think that this is the best deal, and this is also the best deal. It's the same trade, should you be called out without the dividend. So what you want to do, and let's walk through this, you want to sell, okay, you want to sell the June $49 Verizon put. Theoretically, you could sell the May week 4, but again, this is a coaching experience. We did a very short term with Seadrill in the previous trade. I wanted to do something a little bit more in a month out, which had a very good return. If for some reason you wanted to do the May week 4, go ahead and do it. You might even want to do the May week 4, May week 5, in June. You may want to do weeklies, but remember the goal here is to hopefully be called out, and then you're called out, you own the shares, and you sell the calls. And not call out, you put the shares. Excuse me, going too fast. But what you're going to do is you're going to sell the June $49 Verizon put. You'll hopefully be put the shares, and then you'll turn around and you'll sell the July $50 calls right here. And this is the combination of the two. This line is what you end up with, and that's your return. Now, I'll be keeping an eye on this, obviously, as well as you should. And if the stock goes south and you're just collecting the money on the put, maybe we buy the put back and sell something closer in. But this is a longer-term trade. This is, call it a more patient trade. and that's one of the reasons why it's in here. But I'll be tracking it and following it. So this is the position that you want to take in Verizon, and of course I've offered you a lot of choices. The May week 4 is not in here, but it clearly is something that you could do. And if you do the weeklies, you'll actually probably generate a little bit more cash than the 76 cents. But remember, I'm liking this for the opportunity to be put to share so we could sell a call. So that's how we wrap up the Verizon trade. Let's go over to Blackstone. Let's call up the chart again. Blackstone, last time I looked, was having a very good day. Blackstone's a terrific stock. It's one of my favorites of all the stocks I follow. And as I said, I own it. I own all 3 of these. But it's having a very nice day. And the chart here is actually quite important. I want to show you a 3-year on Blackstone. Dave, are we picking up this chart?
Yep.
Okay, good. You can see this was a pretty steady climb coming out of the crash. And actually, if you go to 5 years, yeah. But if we go to the year, you can see it's gotten really volatile here because Blackstone's business, for those of you unfamiliar with it, they're a private equity firm that's publicly held. They invest in massive projects. They're also a money manager if you want to put money with them. They're the largest owner of residential housing in the United States, and they're the largest shareholders in 2 companies that just went public, like Quinta Motor Inns and Hilton. I think the recent downturn in the stock, and it's speculation on my part, this is 10 days, let's go to a month. This was because people were disappointed for some reason that the traders were disappointed that the stock did not move on the combined effect of the IPOs of La Quinta and Hilton. So that said, you can see it wants to go back to 30, and now we're here. And I think it's putting in a new base. Take a look. Once it crossed 30, technical traders and investors piled in. They absolutely came in because this is a very good company with a very reasonable yield. It's like 4.5 or 4.8%, and it's grossly undervalued. It's probably worth at least $44 on conservative metrics of how you look at private equity firms. So you can see why I'm bullish on it. Let's take a look at the calculator. We're going to put in. Oh, so these prices are probably pretty current because that was 30.28. You know, it's 30. You know, it's 30.30. So I'm assuming the premiums are the same. And what you're looking at, even if you wanted just a monthly trade, these are very good returns. This is a classic options income blueprint. You might even see this in options income blueprint today or tomorrow or Thursday, just as a straight out monthly June put, which is not what we're here for. But on that basis, if you love the stock at 31, you have a 51% potential return by collecting that money. It's just a very, very, very strong stock. It's volatile, but people really like the underlying company. So let's move down, and you can see you would turn around and sell the July calls. These is on an absolute basis. In case, like me, you already own the shares and you sold these calls, this is what your rate of return would be.
We're not seeing the chart, Michael.
Oh, boogers.
We're still on the chart.
I know. I do hit screen share, and I guess I'm not hitting it hard enough. Let's see if it comes up again.
There it is.
Okay, let's start over. I apologize again. So this short-term position that we have, the short-term position here, if it was just a short-term trade, it was an options income blueprint monthly put, is great returns. These 2 returns are excellent. Let's say you sold them and you were fortunate enough to be put the shares. You accept the shares, and then you move down and you have these 3 choices in selling calls. A deeper in the money one, depending upon how you're doing up here. I wouldn't sell a 30 if you put the shares at 31, and so forth and so on. And you can see if you already own the shares, as I do, this is what your rates of return would be based on the current stock price, not what you purchased it, and so forth and so on. So you can see it's a very, very, very good trade. And remember, if the stock cratered or the stock ran, these returns are going to be higher because we'd closed the position earlier. Then you collect the dividend, which I'm guessing, this is purely a guess, they have an erratic dividend. Their dividend can be as high as 78 cents, it can be low as 20. What I did is just looked at the last quarters. I thought it was the more conservative way to present the position from a coaching and a trading point of view. And then you have these combinations, and I want you to take a look. I'm going to highlight this. Take a look at all your potential returns. And remember, this is not exposed to earnings the way Seadrill is. This is not as volatile stock as Seadrill. It's not subject to world oil prices or the Deepwater Horizon blowout. And I love Seadrill. I own the shares. But this, despite all these high returns, this is in many ways a less volatile stock on headline events. It did go down from 33, 34 to 29 or under 29. That wasn't based on volatility. That was based on the market looking at interest rates and looking at the environment for private equity and completely misreading the company, in addition to traders' disappointments about the impact of the IPOs. The bottom line is that's all headline noise, and it's something that probably was a one-off in terms of the combined impact on the stock. So here you have really, really excellent returns across the board, across 5 different positions. So you have a lot of choices here. Now, these returns are good even if you don't collect the premium. And here, it gets even better in some cases. Let's say you don't collect the dividend and you're called out. Here are your rates of return. So across the board, whatever you mix and match with Blackstone, you have a really excellent position. And here's the position that I'm going to recommend. I'm recommending you sell the $31 in the money put. The stock's at $30.28. Maybe you can put the shares, but you also have 4 weeks. And I think I said this in the update. I had sold Verizon $47 calls, and the stock was over $49. No one called me out. So you never know what's going to happen. So let's step through it. You're going to sell the June $31 puts. Hopefully we put the shares, maybe you're not. But you're still going to be able to buy the shares after June expiration because their ex-dividend date is until the end of July. So you want to own the shares before the ex-dividend date, obviously, but you're going to sell the June $31 put. If you put the shares, you're going to turn around and sell the July, where am I? You're going to sell the July 32s. And this is what you're going to do here. And the combined effect is here. And this is not the highest return, you understand. I'm trying to get us put the shares. You can argue that the June 30, July 31 is a better deal, okay? But I don't think you're going to get put the shares at $30 a share. So that's the reason. I mean, it's up here, but I don't think that's going to happen. It may not even happen at 31 at the way the stock is moving. So I'm also dealing with real-world trading here. We want to be put the shares. That's the philosophy of this trade. So we're going for the 31, and we're going to sell the 32. And you probably ask me, why don't we just sell the 31? It's because down here, we want to capture the appreciation. If you do this trade and you're called out before the dividend, you're going to make a lot of money. It's a 58% return. So this is the ideal trade. You're going to sell the June 31 put. If you put the shares, you're going to turn around and sell the July 32 call. Those expire before it goes ex-dividend. So the odds are very high here that you're going to be able to do this all and collect the dividend as well. So those are the 3 trades. Of the 3 trades, if you're asking me for what I think the best trade is, this is the best trade. I would do this trade first. I would do the Verizon trade second, and I would do the Seadrill trade third, only because of Seadrill's exposure to earnings. So in that order, the June 31 put, July 32 call combination for Blackstone, the June 49 put, July 50 call combination for Verizon, and then for Seadrill, if you just want a short-term trade, it's the May week 435.50 put, and if you want to do a covered combo, you would sell the May week 436 and hopefully be put the shares, and then turn around and sell the June 37. So those are the trades I'm recommending, and if you're going to do one of 3 or none of 3 and you're still looking, the Blackstone trade is I think my favorite as opposed to best, because I can't get into your head about what your preferences are. I would do Verizon second, and I would do Seadrill third. And again, it's not because of Seadrill the company, it's because of the headline risk related to earnings. And that's pretty much it.
Michael, we have a couple questions here.
I hope so.
Don says, if you will not be put the shares in Verizon until June 21st, how are you estimating what the call value is?
First of all, you can be put the shares tomorrow. You don't get put the shares just after or around expiration. If the stock runs, you could be put the shares tomorrow. I said these were placeholders, and you're gonna. That's why we're giving you the calculator so you can put in the prices on an ongoing basis in case you don't do the trades today. About you're going to estimate where they are. Now, let's say you're put the shares 2 weeks from now because the stock is at 49.50 or whatever. Yes, the premiums are going to change, and just use the calculator. Remember, and I probably didn't emphasize this enough, let's go to Verizon. One of the things about this, if you sell a June 49, it's a substandard for us rate of return. But if you're not put the shares, it's still a 18.6% annualized return. If you're put the shares earlier, which you probably would be if the stock is running a bit, you're going to actually have a higher rate of return. You're going to be out of the trade. Your capital will be freed up to sell the call at the time. It's a good question. I don't mean to be flippant or anything. It's a very good question. We had to do placeholders because this is a coaching service, and you're going to be using the spreadsheet to keep an eye on these things. If you like the logic and you don't necessarily want the premium for selling the put, then buy the shares and turn this into a buy right. And you can do that. Obviously, you can use the calculator. And if I'm not going to, let me call this a different name so I don't screw up what we did. I just want to save this. Let's say you bought the shares and you just sold calls, and it was at this basis. You would put a 0 in for the put, and all your calculations down here change. And instead of putting in the strike price of where you'll put the shares, you would put in the price down here, this cell of what you paid for the shares. So you can use this calculator. It's the same thing as the position calculator we gave you 3-4 weeks ago. You can fiddle with this if you just want to go out and buy the shares and sell the calls. You can use this as well, and the premium information for everything is still in there. So it's very simple to use to track. So if you like the Verizon trade, buy the shares today, buy them tomorrow, and go around, just turn the shares. You can still use this calculator to do the calculations for that.
Okay, Stephen asks, what would be the maximum acceptable commission be put the shares?
What do you mean? You mean how much commission will you pay? Whatever the standard commission is per a block of shares. We had the question during the boot camp that some of you were getting nailed by your brokerage houses by special fees when you're either called out or you're assigned the shares. I would get on the phone, because it's buried in websites. It's hard to find. Get on the phone and call customer service at your broker. Find out if they have some silly fee for being assigned the shares. And Dave, isn't there a handout on the website that has the percentages?
Yeah, in the boot camp we put that up there.
In the boot camp, there's
a percentage is actually the dollar amounts for trades that cost at most of the online brokers.
Could you restate that for everybody, because I interrupted you?
Yeah, we have the prices. Usually they're around $7 or $8 for being assigned. Basically the same charge as being a commission for a trade. One broker, TD Ameritrade, charges $17, but if you have a big enough account with them, you can call them up and talk that down. They won't charge you that. Somebody though mentioned before they were getting charged $49 or $59, which is pretty absurd. For it's either a full service, you're not using sort of one of the traditional bigger online brokers. So. Question from Roger: do you have a source for ex-dividend dates? Future dates are difficult to find.
Well, I go to Google, I type in ex-dividend date Verizon or ex-dividend date VZ, and 99 out of 100 times when you do that, the NASDAQ site comes up. And the NASDAQ has the dividend history. Dividend.com is a premium service that you pay for the dividends for everybody. But if you want to save it's like $400 a year, and I don't subscribe to it anymore. I used to. You just go to Google, you type in ex-dividend date for the stock. If it's not on the NASDAQ, it's usually the exchanges have the information, or it'll be in a press release somewhere on Google. And often what you have to do is look through, actually, let me do this live, if that's all right with you, Dave.
Yeah.
Let me go back to the internet. Okay. So we're going to go back here, and I'll show you what I did. Are we picking this up?
Yep.
Okay, ex-dividend date VZ. And I just clicked on it, and there's a write-up, and usually there's a history. And you can type in this box. You could do it for Blackstone. And, here's the the last dividend in the charts and whatever. It's all here. It's all, no thank you. And so it's all there, and even a Dow stock or something like that, ex-dividend date. I never ask. You should never ask a question you don't know the answer to. But let's see what happens when I type in Alcoa and dividend date history. The Nasdaq has it even if it's not a Nasdaq stock. So here's the typical chart, and you would see that they went ex-dividend on May 8th. Big dividend, 3 cents, and you can see it's always the first week or the first 8 days, 9 days of the month. So if they don't have the next one, you go out 3 months and just assume within it's a 3 to 4 day window of the previous ex-dividend date. So if it was May 8th, it would be May to June, June to July, July to August. Assume between August 5th and August 10th is going to be the ex-dividend date. If you're really desperate to know, you just shoot an email to their financial relations office and they'll tell you in a moment.
Yeah, I think the question is looking forward. It's not so much the back, but if like a Verizon, I know that you can pretty much estimate 3 months ahead, and then as you get closer to the date, they're going to have it on the.
Yes, Dave's right. Between 10 and 21 days, they will announce when they're going ex-dividend.
If they're paying quarterly, you can get that.
And you can see what I've been looking at, and because the Nasdaq puts a cookie on your site and tracks all the stocks. So once you're there and you start using this, you can put all your stocks up there that have a dividend. And you can see in Blackstone, for example, you can see it's irregular. This is 2 months, this is 3, this is 2, and so forth and so on. But there's no reason to spend any money to do this. You should be able to get it for free.
Right. Stephen just asked, he offered the comment that he is with Canadian iTrade, so he's in Canada, and it's $59. It's a one free trade per month on the assignment, and then otherwise it's 59 Canadian dollars.
That's a lot. That's ouch. Yeah, it's definitely an ouch.
If you have a significant size account there, you ought to get on the phone and see if you can't get that negotiated down, because that seems like a lot of money for if you have any kind of money volume or trading volume there.
Yeah.
Okay, I think that's all we have on the questions. Any more questions?
And if you are looking these over and you don't have to execute them right now, as most of these are longer term, just shoot me an email at myportfoliocoach@gmail.com. Dave?
We'll write them up on the put them up in the trade recommendations on the coaching site as well.
Absolutely, yes. And I'll be putting the calculator up. I'm sending it with the things I just typed in. It'll be posted in a relatively short period of time.
Okay, great.
Thanks, everybody.
Thank you, everybody.